Welcome to my beginner's guide on investing in startups. Now, I need to preface this with I'm not providing investment advice. This is an entertainment and educational purposes only, and it's just based on my experience and how I would approach it for myself personally. But hopefully it's of interest and value to you. All right, let's get started. So maybe you've heard of some of the phenomenal returns that can occur in the world of venture capital and startup investing. For example, Lance Armstrong. Yes, that Lance Armstrong. Did you know that he is today a billionaire? And he is a billionaire not because of his cycling or his sponsorship deals or any of those things. He's a billionaire because he was one of the early investors in Uber. Yep, he invested $100,000 in Uber, which at its peak was valued at over $1 billion. And this all happened, he became famous, made the investment, became infamous, lost all of his sponsorship deals, all of that stuff. And then Uber went public at $100 billion plus valuation, and he owned a sizable chunk of that. So there are massive returns to be had. Now, that said, not everybody generates a huge return like Lance Armstrong, obviously. And there's a tremendous amount of risk in the industry. So I'm going to talk you through how I would approach investing in startups, because I believe that investing in startups should be part of everybody's overall portfolio. Otherwise, you're going to miss out on some potentially life-changing opportunities. So the first thing we need to start with is funds, right? Where are you going to get the money to start investing? Hopefully, you have a job or other sources of income, and you need to figure out how much of that income you're going to put to work towards investing in startups. And this matters for a few reasons. One, obviously, the more money you're able to play with, the more potential you have of generating outsized returns. But the other piece is that you will only get access to certain types of deals depending on how much money you can put to work and invest. I mean, some companies, they won't even talk to you unless you're willing to write $1 million check, right? And there are others that are willing to play ball if you can write a $100 check. But you need to understand the different venues for getting access to those type of deals and the amount of money you're going to put to work. The other thing is, like I said, this is a super risky place to invest. And I really like the barbell investment strategy for thinking about portfolio allocation or how much money you want to put towards investing in startups. So in my mind, I would put enough money in there that you could totally lose it and it would not impact your lifestyle at all, but put enough money in that it would be life-changing if it ended up being successful. So that is really what the barbell strategy is about. It's like putting a little bit of money into things that are highly risky but could be life-changing if successful, but not life-changing if you lost it all, and putting the rest into more safe, secure assets. And if you push it to the extreme, it's like put 10% of your wealth into insanely risky things and put the rest into cold hard cash or gold or something like that. Now, again, not providing investment advice, but that's the types of things that I would be thinking about as I was constructing my own portfolio. What is the amount that I can afford to lose while still being big enough that it would fundamentally change my life if I achieved a 100, 200, 1000x return? All right, once you've figured that out, the next thing you need to figure out is, are you an accredited investor or are you a non-accredited investor? If you're accredited, frankly, that just opens up this whole additional world of potential investments that you can make. Now, the criteria for being accredited is you meet one of three criteria. The first one is you have annual income for the last several years and expected to continue to make at least $200,000 individually or $300,000 with your spouse. The other criteria is you have a net worth of $1 million or more outside of your primary residence. So if you live in a really expensive $1 million house because real estate's gone through the roof, sorry, but you don't get to count that. But it could be like other assets you might have, your 401k, it could be the money that you have in other real estate projects or rental properties or what have you. Those could all count towards your total net worth. Of course, it is net worth, so you have to subtract out any loans that you owe against those assets. And then the third one is probably, in some ways, like the easiest and hardest to qualify with, and that is that you demonstrate that you are a knowledgeable person in the industry. And you do that by passing the Series 7, Series 65, or Series 82 exams. I say that they're in some ways the easiest and hardest because you do have to take a test, and the tests are not easy. I recommend the Series 65. It's probably the easiest of the three, and you don't have to be sponsored by a larger entity in order to take that test and receive that qualification. But nonetheless, if you're just already making a decent amount of money, you don't need to take the test. You can just qualify that way, and hence that's why it might be a slightly easier route to go. Don't worry though, if you're not accredited and you don't have the ability to take the Series 65, you can still invest in startups, and I'm going to talk about how. Okay, so let's just start with non-accredited, because if you're accredited, you have access to these deals as well. If you're a non-accredited investor, then I would go and I would look at the major equity crowdfunding platforms. The top three are StartEngine, WeFunder, and Republic. And all three are great platforms and have really interesting deal flow, and that's worth considering. Now, I'll just touch really briefly on all three and my perspective and opinion on each. Before I jump into these three, I should admit and disclose that I'm actually an investor in WeFunder and Republic, and a huge fan of StartEngine as well, and have pretty deep relationships with all three. So with that out of the way, let's talk about each one individually. So Republic, I think, is a great platform if you care about impact-related investments. So backing women founders, founders of color, impact-related investments. They also do a good job of screening out a lot of bad investment opportunities. And so the stuff you're going to get, is going to have roughly 6 months of runway before they run out of money. They're going to have some interesting traction already. They might have some really interesting investors. Like Republic is probably of the three the hardest to list your company on, because they put startups through a lot more rigorous testing and approval processes than the other two. And that works for and against you. So from my perspective, Republic is really good at kind of avoiding crappy companies, but sometimes their process to get approval is so hard that really, really great companies that don't really need one of these platforms don't go on it because they don't want to go through the process of being on the Republic platform. So you get really good stuff right in the middle. The next platform worth looking at, in my opinion, is WeFunder. WeFunder is a lot more open. They have a different philosophy in terms of working with startups. They're kind of like, hey, we're going to put lots of great stuff out there, and we'll let our community decide. And what that results in is they have this super wide range of quality. In my opinion, they've got some amazing companies that come on the platform, raise money super fast, and are off. And those can represent really cool opportunities where the company is like, we don't need the money, but we want to provide this opportunity for our community. And so they get on, they blast it out to their community, they raise a ton of money really quickly, and then they're off the platform, right? And then you also, on the other extreme, you've got, it's a little bit of the Wild West. You've got crazy ideas that probably aren't going to go anywhere, but that are on the platform, and WeFunder is kind of providing a venue for them. And then from my experience, StartEngine resides somewhere in between those two extremes. They're not quite as rigorous in terms of vetting every single company that comes on their platform as a Republic, but the flip side is they're not the bit of the Wild West that WeFunder is, and so they reside somewhere in the middle. All that said, you can find great deals on all three platforms, and all three are worth your time and attention. It's just up to you to actually dig in and identify the deals that fit best for you, which we're going to talk about. Okay, let's assume that you're accredited. Where do you go? What do you do? So what I would do if I was a brand new beginner is I would go on angellist. So go to angellist.com. I have no direct affiliation with angellist. I just think it's a great site and a huge fan of Naval, the founder. angellist has two interesting vehicles for investment that might appeal to you and that I would recommend. So the first is syndicates. Now, syndicates are this platform where angel investors, larger angel investors, more well-known with large followings on Twitter and so forth, can go on and they can put together these mini funds. So Jason Calacanis is a great example of this. He's been a syndicate investor on AngelList for a very long time, invested in some really great companies like Calm, the meditation app that's done really well. And what he does is basically, if you're a fan of Jason, then you say, hey, okay, I'm going to give money to this deal that Jason's doing. And Jason kind of pools all of that money together, and maybe it's $500,000 or whatever, and he invests. And then he gets a piece of the profits for pulling together that deal in that syndicate. So it's deal by deal. You can kind of decide what deals you want to invest in or not. You can kind of follow a whole bunch of angels. that are syndicators on that platform and make investments alongside them. It can be a great way to dip your toe in the water and start getting exposure. And you can write really low checks, like $1,000, which also makes it great. The other product that AngelList has that could be interesting to you is their rolling funds. Now, a rolling fund is similar to the syndicates, except for it's more like a fund structure. And what you do is you commit, you say, okay, I'm going to invest $100,000 a year with this investor, and they're going to call that capital, right? They're gonna ask you to wire it over or do a bank transfer once a quarter, so $25,000 every quarter, and it'll just keep going quarter after quarter, and they'll invest that on your behalf. And different rolling funds will have different minimums. So some will have minimums that are 100,000, some will have minimums that are as low as like $10,000, which can be a really great way if you don't have a ton of money to get into the game, because they're already going to invest in a whole bunch of startups on your behalf. The downside, though, with that is that you're not going to be as involved in the day-to-day decision-making process, which really is going to kind of limit your ability to build expertise over time. Now, I know this has been a long video so far, so I want to just hit on a few things, though, that I would look for when I'm looking at startups that should be in your mind as you're going through the process and picking which companies you want to invest in, whether it's on AngelList or whether it's on one of the equity crowdfunding platforms. So I'm going to give you a list of things that I think are important to consider. And not necessarily in any particular order. I think they're all super important. The first thing is pain point. Make sure that the company that you're going to invest in is solving a huge pain point in a way that other people aren't solving it, or that it's not being solved today. And so that's one. Like, really understand the product and the pain point that's being solved. And you should, like, ideally, you should be investing, at least to get going, in companies where you feel that pain point, where you resonate with it, and where you can really identify if that product is something that's unique in the market and doing something like really special. The next piece that I'd look at is the market huge? Now, what you kind of want is, you want, especially at like the really early stages of investing, you want to be investing in places that are really, really big, right, market-wise. There are a lot of people that feel this pain point, and or they're willing to spend a lot of money to have that pain point solved. For example, when Uber raised money from people like Lance Armstrong, I kind of struggled with it because I was like, I don't think the market's that big. And what I missed was that the market was not like the taxi market. It was the transportation market, which is $1 trillion plus market. That's the kind of markets you want to be investing in, because it allows room for the company to grow and become really big and generate those like 100,000x possible returns. The next thing you want to do is you want to look at the team. Is the team the right one for this pain point and this market? Right? Do they have the right experience? Do they have the right know-how? Do they have the right perspective and vision in order to make this thing successful? Are they people you can trust with your money? And so spending some time really understanding the management team and getting as much information about who they are can be vitally important. The next thing is, I would look at the valuation. Now, the valuation has to be low enough for you to generate a huge return if this company is successful. So for example, you wouldn't have generated as good of a return on Uber if you had invested at $1 billion valuation as if you invested it at $10 million valuation. So you want to be thinking about like, hey, what's the potential size of this company by the time they go public or get acquired? And it can be helpful to look at parallel type businesses. So if it's a software as a service business that's serving like restaurants, then you might look at other companies like Toast, for example, that provide software for restaurants to get a gauge on like how big these companies can ultimately become. And then from there, decide, okay, look, I think it's very low likelihood that this company will be successful, but if they do, I want to generate like 1,000 times return. And so basic valuation could be like, hey, I think if they're successful, they could be worth $10 billion. But in order for me to generate like a really good return that justifies that, I want like 1,000 times of my money, which means I need to invest today at maybe a $10 million valuation. So be thinking through like the valuation and the impact that can have. I think one of the biggest pitfalls that new investors have is that they get so caught up in the vision and the product and the team, and like they're just so passionate and excited about it that they kind of neglect the valuation, and then they end up not performing quite as well as they could have if they had paid attention to that. But ultimately, never pass on a great deal just because of valuation. It's just something you want to be keeping in mind. Anyways, I hope this was helpful. Anyways, tell me your thoughts or your strategies if you're investing in startups already, or whether or not this video is helpful, or what other questions you might have down in the comments below. And be sure to check out some of my other videos, like what is a liquidation preference, which is a key term when you're making investments in startups. Thanks.